Hi, today I want to talk about something that most people have never heard of. How buying a short term rental property can actually help you keep more of your income by significantly lowering your tax bill. So, if you're looking for ways to invest smarter, this might be one of the most powerful and underused strategies out there, something that you probably never heard about. My name is Bent Danholm, and I'm a real estate broker and owner at Max Realty Orlando. I'm also a real estate marketing expert and a real estate investor myself. And I made it sort of my mission with these videos to help you make smarter real estate decisions, whatever you're buying or selling. If you're buying your personal home or you're buying an investment home, I try to make videos that are useful and easy with advice that's easy to follow and pretty straightforward. Before we go into today's topic, I want to make it absolutely clear. I am not a tax advisor. I'm not a tax planner. I'm not an investment advisor. I'm not a CPA or anything like that. I am just a real estate professional. So this video should not be taken as tax advice, investment advice, or anything like this. This video is made solely for real estate purposes and for general information. So if you are planning on using any of the methods I'm mentioning in this video, I would strongly advise that you speak with the appropriate professional first. That's really important. So now that we got that out of the way, let's get into it. And I know taxes aren't exactly the most exciting topic in the world, but stay with me, because once you understand how this works, you will come to realization that real estate isn't just about monthly cash flow or long-term appreciation. It's a lot about tax efficiency. And that's often where the real money is made. So today we're going to talk about a concept called not tax, but cost segregation. It might sound complicated and a little bit strange, but it's actually very straightforward when you break it down. And this is not some loophole in the tax law. It's not some shady method to save money. This is actually just smart utilization of the tools that you have at your disposal when you're investing in real estate. So when you buy a rental property, you are allowed to depreciate the value of the building over 27 and a half years. That's the standard IRS policy. So if your building is worth, let's say, 500,000, you get to write off around $18,000 per year over 27 and a half years in depreciation. And that's good. It's very good. It's fine, but it's really slow. So, and there's something more to it. Not everything in that property actually lasts 27 and a half years. Think about things like your washer, your dryer, your kitchen, your landscaping, your carpet, your light fixtures, your driveway, the fencing, lots of things on a property that wear out a lot faster than 27 and a half years, usually somewhere between 5 and 15 years. So what cost segregation is, it's a strategy where an engineer or specialist come in, they study a property, and they break out those faster depreciation parts into their own categories. So you sort of like a little bucket. This part of the property will probably last 5 years. This part will last 7 years. This part will last 15 years. And the rest of it will probably last 27 and a half years. And then that allows you to write off a big portion of the purchase price much, much faster. In some cases, even in the very first year, or the majority of it in the first year. So instead of a slow drip of $18,000 a year, you might get 75,000, 100,000, maybe even 150,000 in depreciation all at once. And that can wipe out a huge portion of your taxable income. And this is exactly where short-term rentals comes in. Normally, if you buy a long-term rental, a house or a condo or something that you rent out on a longer term, typically to a tenant on a 12-month lease, these big depreciation, you can still do the cost segregation, but the losses of the depreciation can only be used to offset other rental income. That means that unless you have a bunch of rental properties generating profit for you, those deductions just sit there. And in most cases, it probably makes more sense to just depreciate the whole thing over 27 and a half years, because they're going to carry forward to future years anyway, and they will not help you right now. But short-term rentals are different. The IRS treats short-term rentals differently if you meet certain requirements called material participation. And that's sort of the magic ingredient. When you materially participate in a short-term rental, those depreciation losses can be used to offset your regular income. And your regular income, such as your W-2 job, your 1099 income, which is your business earnings, whatever you basically make, you can offset these depreciations against that income. So now, instead of waiting years to use these deductions, you can use them this year. And that's really a true game changer. So let me give you an example. Let's say that you make $200,000 a year in taxable income from your job or through your business, and you buy a short-term rental. You pay, let's say, $600,000 for it, and you get a cost segregation study done. Remember, you cannot do this yourself. It has to be somebody who's qualified. And this study identifies $150,000 of items that could be depreciated right away. You also could qualify as materially participating, meaning that you are actually physically, personally involved in the management, booking, and guest communication, etc. So now, because you're materially participating in running of the rental property, and you've done the cost segregation, you can take that $150,000 deduction, and that can bring down your taxable income from $200,000 to $50,000. As I said in the beginning, I'm not a tax expert or a CPA, but as far as I can tell, that could easily save you $40,000 or more in taxes, depending on your initial tax bracket. And it's not wishful thinking or some dodgy way of avoiding a tax payment. It's simply how the tax code works. So let's talk a little bit more about what it means to be materially participating in the management. Because it does not mean that you have to manage the property full time, or it doesn't even mean that you have to do everything yourself. But you do need to be involved in the running of that property. The IRS, with this, has so many other things. They have a few different tests, but the most common one is this: that you spend over 100 hours per year. And that is, if my math is correct, about 8-9 hours a month working on your short-term rental. And another thing, no other individual spends more time than you do. So let's say you're answering guest messages, you adjust pricing, you're handling the booking calendar, maybe you manage the cleaning schedule, all of that counts. So if you outsource 100% of the work and just collect the income, you will not qualify. But if you're active and involved, there's a pretty good chance that you will be qualified. And if you're married and file jointly, your spouse's hours will count too. This rule gives a huge advantage to people who are willing to be hands-on with their short-term rental, even if they're doing it part-time, because 100 hours a year is not anywhere near a full-time job. So, and now there's actually another piece to this puzzle, and that's what they call bonus depreciation. Bonus depreciation allows you to take those faster depreciating assets that we talked about, like the appliances, the furniture, the carpet, the driveway, the landscaping, the shed, whatever else you have that can be put into that bucket of quicker depreciating assets. And in some cases, you can deduct them in one single year instead of spreading them out. A few years ago, you could deduct 100% of those costs upfront. Started in 2023, they started to phase that percentage down. So in 2025, it's 60%. So, but that's still a huge benefit, a huge chunk of money you can get back straight away or save straight away. So the bottom line to this is, even if you wait, this is good, this is big in terms of tax savings, but the sooner you act, the bigger deduction you can get right now. So if you're considering investing in short-term rental, now might actually be the strategically right time to do it before the bonus depreciation phases out even further. So let's look at the big picture here. With one single purchase, a short-term rental that you can actively manage, you can earn nightly rental income that often is much higher than long-term rentals. You can still build long-term equity and appreciation because over time, all real estate historically has gone up. And and with this, you can create a massive tax deduction that can reduce or potentially in some cases eliminate your income taxes this year. That is why a lot of investors are moving into this space. And you don't really have to be a millionaire to do it. You just have to be a little strategic. And that's exactly why I'm sharing this, because I know a lot of people can do this. And like I said, it's not about loopholes, it's not about tax tricks. It is simply about using the tax code the way it was written, and that was to incentivize investment in real estate. You're providing a service, you're creating housing for travelers and business professionals or people on vacation, and the IRS rewards that through depreciation and cost recovery. You just need to know how to take advantage of it. So here's what I would recommend if this is something you're interested in. First of all, find out if a short-term rental makes sense for you, for your goals, your budget, and your long-term goals in life. And look at the income potential, local regulations, and seasonal demand. And somebody like me who knows the market can help you with that. And then if you think that's the way to move forward and you're ready to get involved, and you're ready to qualify as a material participant, then I would suggest that you talk to a CPA who understands short-term rentals and cost segregation, because not all accountants do. You want someone who can walk you through exactly how the numbers would work in your specific situation. And then, and only then, if you want help finding the right property, I would love to talk to you, because that's exactly what I do. I specialize in helping investors finding the right investment properties, whether they're short-term or long-term, properties with strong income potential and high tax efficiency. Because let's face it, not all properties are created equally. The difference between a break-even rental and a wealth-building investment is really just strategy, and that's where I can help. So whether you're brand new to real estate or already own a few properties, this strategy might be the missing piece that you've been looking for. And I'd like to ask a question here, because in my experience, not a lot of people know about this. So I would like to know if you actually knew that this is an option in the tax code, that this is something that can be done. And if you do, have you ever utilized it? If you didn't know about it, is it something that has opened your eyes for potentially moving into a different kind of investment, like short-term rentals? Well, any thoughts really would be appreciated in the comments, and I look and respond to every single one of them. And if you like the content of this video, give it a thumbs up, a like, and share it with somebody you know could be interested in buying an investment property of any sort, but specifically if they're looking to a short-term rental. And again, maybe subscribe to the channel so you get so you don't miss anything next time I upload it. But the thing is, if you subscribe, you should also hit that little notification bell. Otherwise, YouTube will not let you know when I upload the next one. I hope you enjoyed the video, and I hope I opened your eyes to something that you had never heard of it, how you can actually buy a short-term rental property that could help you keep more of your income and by significantly lowering your tax bill. Thank you so much for watching.
Hey, it's Bent Danholm, and listen, if you don't follow this channel, there's a good chance you'll never see me again. I consistently create helpful content for those who are currently in the real estate market. This information can be extremely helpful for your buying and selling needs, so be sure you like and subscribe here. And most importantly, leave a comment to let us know if this video was helpful for you. We're here to help the Central Florida community, and we always love your thoughts and questions. Follow now, and I'll see you with our next helpful video.